live from Bloomberg's brand new Mumbai studio. This is Inside with me, Haslinda Amin, where we dive deeper into the stories that matter with crucial context and sharp analysis. Trump's tariffs on Canada, Mexico and China rock Asian markets with the dollar and oil gaining while equities see red. The leaders of all three countries say they are taking retaliatory measures. However, China's response so far has been a bit more guarded than before. Amid Trump's tariff blitz, India is cutting import duty on some U.S.-made goods as the government presents a budget geared towards middle-class tax relief. And we have a great lineup of guests to give us more insight into the tariff impact. Morgan Stanley's chief Asia economist Chetan Ahya is with us shortly. And later, we have the chief economic advisor to the Indian government and the former CEO of one of Asia's biggest banks. Well, President Trump warned the world that trade tariffs were coming, and now the impact is reverberating across global markets. After imposing sweeping measures against China, Canada and Mexico, he's doubling down, saying more is to come and singling out, by the way, the European Union. Here's what he had to say as he made his way back to the White House a couple of hours ago.
It will definitely happen with the European Union, I can tell you that, because they've really taken advantage of us. And, you know, we have over a $300 billion deficit. I wouldn't say there's a timeline, but it's going to be pretty soon.
The fastest response so far has been out of Canada. Prime Minister Justin Trudeau announcing retaliatory 25% tariffs on more than $100 billion worth of U.S. goods starting Tuesday. The first wave includes products from orange juice to motorcycles, with more possibly coming later this month. Mexican President Claudia Sheinbaum says she will announce a Plan B on Monday to defend her country's trade. Sheinbaum says she's looking for both tariff and non-tariff measures from her economy minister. China, for its part, took a more measured response to Trump's tariffs, with President Xi Jinping taking a breath before his nation announces any concrete retaliation. For more on this, let's bring in our chief North China correspondent, Stephen Angle, in our Hong Kong studio, and our markets reporter, Avril Hong, is also with us in Singapore. Steve, let's start with you. What's Beijing saying so far?
They're not saying a lot. Yeah, they're taking a bit of more of a, as you said, a measured approach to this, because this could just be the beginning of what could be, as Trump has threatened on the campaign trail, more tariffs, staggered perhaps as high as 60%. Keep in mind, this 10% tariff that takes effect tomorrow, February 4th, is the 10% that he tied to the fentanyl trade. It's not necessarily because of the trade deficit and the trade practices of China. So those are still potentially in the pike or potentially negotiable. But right now, it's that 10% that China has to respond to. They don't want to use all their arrows in the quiver, if you want to use that analogy right now. So what we're hearing from the Commerce Ministry, they express strong dissatisfaction, not the strongest language, but still kind of expected verbiage. They also viewed corresponding countermeasures as a possibility without elaborating. They've also pledged to file a complaint at the WTO citing serious violation of international trade rules. Now, that's on the response to the Trump tariff threat. There's also been a response in state media to what is behind the tariffs, and that is the fentanyl trade, something that China has not actually acknowledged that they are sending, allegedly, the precursors of that drug potentially to Mexico. Yes, Biden, the previous president, did have a frank conversation on the sidelines of APEC in San Francisco, and Xi Jinping, according to state media, vowed to do what he could. But again, there has never been a public acknowledgement. But state media is out with a fairly harsh statement today, essentially saying addressing the fentanyl issue requires cooperation, not unilateral trade coercion. Anyway, we do expect, as China comes out of the Lunar New Year holiday, further statements from the actual Ministry of Foreign Affairs, perhaps.
And of course, it is the tit-for-tat arrangement that's, sending nerves in the market. Let's bring in Avril. Avril, how are we looking at this? How are markets looking at this? If you take a look at what we're seeing, it's pretty much red across the board, and some benchmarks are down more than 3% today.
Yeah, I mean, it's a sea of red, and the Greater China markets that are back from the holiday are the ones that are particularly hard hit. Some of this decline is related to the scrutiny surrounding DeepSeek, but overall it tells you, based on the price action we're seeing, that the tariff risks and the ensuing retaliatory action has not been fully priced in by the markets. Hence, this reaction that you're seeing that's selling today. And among the sectors we're keeping a particularly close watch on, those online retailers. Some of these plans on tariffs include removal of exemptions for packages below $800 in value, for example. And the chip sector that has been really front and center of the US-China tech rivalry, that could come under further pressure given the scrutiny surrounding DeepSeek. Keep in mind as well that when it comes to China shares listed in Hong Kong, or the 8 shares, we're actually seeing that ahead of the Lunar New Year holiday, they've been coming down or rising a fair bit, I should say. And this is against the backdrop of what we're seeing in, the bullish sentiment and positioning being priced in by the market. So they were kind of already bracing for a bit of a reversal today. And indeed, that is being reflected in the price action. Of course, the yuan has been front and center given the greenback moves. And, we're seeing potentially record lows if China decides to take things to the limit as far as retaliatory action is concerned, to the levels we saw in 2018, 2019. That could really hit the Chinese yuan. Already, it's a bit of a head-scratcher today that the yuan is outperforming. Maybe there's been some intervention stealthily, but you're already seeing the onshore-offshore spreads. They've been widening to pretty uncomfortable levels. It's really a question mark of what Beijing PBOC decides to do on Wednesday when the onshore markets come back. We have the likes of Goldman, for example, saying that now that the tariffs have been announced, the fix that had been at 718 for much of January, that could start trending higher.
That's right. I mean, Trump may just force China's hands. Perhaps we may see the deeper stimulus that the world has been waiting for. Steve, the thing is, China needs to respond. It wants to respond. How does it respond without hurting its own economy? This is an economy that's already struggling to recover.
You're absolutely right. And that's why the response is kind of two sides of the same coin. There has to be response for political reasons and domestic reasons for Xi Jinping to respond to the unilateral tariffs coming from the Trump administration. Then they also have to formulate a response to the shocks that will hit the Chinese economy. I'll take that point first. Essentially, Bloomberg Intelligence, Chang Shu, who's our Bloomberg chief Asia economist, is saying that the 10 percentage point hike in tariffs could slice as much as 40% off China's exports to the United States, shaving as much, in the worst case scenario, 0.9% off China's GDP. So it's going to take a hit at a time, of course, where the Chinese economy is still trying to get its footing and come out of this, years-long slump in the property sector. They've really been propped up by its strength in exports. So if you take that pillar out, how badly is the Chinese economy going to suffer, and what is going to be the policy response, perhaps at the National People's Congress in a month's time? But as far as retaliation, if you will, it can't be like for like because of the trade imbalances with the United States. So there could be further export controls on key minerals. There could be market access restrictions against American companies. I'm sure all of that has either already been formulated in Beijing and going to be released over time, or after the holiday is over, wham, they come out. We'll have to see.
That's right. What we know is that China is more ready this time round to respond to those tariffs imposed on its economy. Avril, we're seeing major moves across the globe, including cryptocurrencies. Tell us more about that.
Yeah, I mean, you speak of how that action from Beijing is maybe already being braced for. It was also really interesting how quickly we saw Canada retaliating, and some have already flagged that as far as these levies are concerned, at 25%, maybe they were a lot worse than some had anticipated. But it's really interesting how we're seeing that dollar resuming its upward march, the loonie hitting levels we haven't seen since 2003 against the greenback, peso hitting 3-year lows, and really interesting as well, some of the reversal in the weakness of the loonie. To some, this speaks to the view that tariffs won't last. Remember what happened with Colombia. Also interesting in terms of the action in markets today, if you look at U.S. Treasuries, that they really didn't provide much protection against the tariff risk because the selling was still quite pronounced on the short end. When you look at U.S. bonds, you talk about cryptos. That might be part of the markets, no thanks to the retail participation, maybe some capitulation there. So Bitcoin, Ether slumping as well. But what also was jumping was oil. Remember, Canada, the U.S.'s biggest supplier of energy, 10% levies there. The concerns about the rise in feedstock costs and prices jumping at the pump.
That's right. And speaking of Ether, it slumped 26%. April Hong, Stephen Angle, we thank you so much for your thoughts today. Well, let's bring in our guest. He believes the conundrum that EM Asia central banks are facing is becoming even more complicated as tariffs now enter the conversation. Let's bring in Chetan, Ahya, Chief Asia Economist at Morgan Stanley. Chetan, good to have you with us. My, take a look. The surge in the dollar, oil is rising. How do you play this market?
Well, I'm an economist, so I will focus on the macro side. So look, I think the most important message that I wanted to have for your viewers is that looking at the 2019 experience, when you see tariffs going up on multiple trade partners at the same time, and also in a broad-based manner, the implication for region will come from the fact that there will be an adverse impact on global corporate confidence, global capex, and therefore global trade. So we might be just focused on the bilateral implications of what U.S. is doing to China's exports. But what we would be more focused on the fact that, this is really going up in a broad-based manner. The other important point that I wanted to highlight is the fact that, look, this is, as Stephen was mentioning earlier, this is just the first debate or issue that is being taken up with China. We know that the America First policy document has recommended that the president is saying that they need to look into the China trade relationship in 2 other areas, which is whether the big trade surpluses that China is running with the U.S. is with fair trade practices. And then the second one is also related to the Phase 1 deal, whether that fulfillment of the commitment of Phase 1 deal has been done or not. And so we are still keeping in our base case additional 25% tariff going up on China, and weighted average tariff increase will be 15%, because that is under a separate channel under Section 301. So when you think about all of these factors, we are very concerned on the global trade outlook, Asia's exports, and therefore implications of trade-oriented economies in the region.
So what does it mean in terms of global growth? What is in your calculation? If we talk about trade getting impacted, what will that translate to in the end in terms of global growth?
Well, we are still assessing the implications on global growth. There's definitely downside risk. And overnight, our U.S. team has highlighted the downside risk to the U.S. And we've highlighted the downside risk to Asia's growth because of the tariffs that have come up. So I think the risk is clearly to the downside. And I think in terms of magnitude, if I were to quantify for the region, what we are saying is that, in 2018-19, region's growth took a hit of 1 percentage points. In 1 percentage point rather. And in this cycle, we think that the damage, if these tariffs stick, whatever was announced yesterday, then you will probably see either similar damage to region's growth or more. And the reason to mention the point that it could be even more than 2018-19 is because if you recall, in 2018-19, it was just tariffs going up on China in a phased manner, and there were a few products that were exempted. But right now, what we're hearing is that tariffs are going up in a broad-based manner on multiple trade partners. And so we think that the damage to regions' exports outlook could be more than what you saw in 2018-19.
Chetan, how concerned are you about the dollar levels? I mean, this is one currency that stayed strong for a very long time, despite initial expectations that we'll see a weakening in its currency. I'm just wondering how you see that playing out in terms of Asian currencies. I mean, the likes of the rupee, the rupiah, the Thai baht. What kind of damage do you see?
So I think, it is all going to be, everybody is going to see depreciation. Our U.S. macro strategy team is indicating that, on account of these tariff announcements, if they stick, the trade-weighted dollar, DXY, could appreciate by about 4%. And so we will see similar downside in Asian currencies, just matching whatever happens to the broad dollar. And at the same time, we think that, what happens usually is that CNY depreciates less because it's a lower beta currency. And the other more trade-oriented economies' currencies tend to depreciate more when you are here in the thick and thin of this news flow of tariff.
And in terms of action from central banks, how complicated is it for them now? I mean, we know India is set to cut its rates this month.
Yeah, in terms of central banks, look, the way we are saying is that this will evolve in two phases. Initially, when tariffs are being levied and dollar is appreciating, central banks in the region will be hesitant. They will cut rates, but they will be more cautious in the pace of rate cuts. But what this means is that there has been a significant growth downside risk for the region, and tariffs in general for region will be deflationary. So cumulative rate cuts that the central banks will take up in the region will be more than what we have, or rather, I would say, had in our base case until these tariffs went up. And so, yeah, I think you should see more rate cuts eventually, but initially it will be paced at a slower pace.
Chetan, let's talk about the Indian budget released on Saturday. Some say that it was fiscally prudent, others say it was bold and beautiful. What's the key takeaway for you?
So I would say the budget has done a great job in terms of balancing the two kind of objectives that the government had. Number one is that they had to keep and stay on track on fiscal consolidation. So with the overall constraint of having to consolidate the deficits and reduce it further, we think that the government did an excellent job of trying to, at the same time, stimulate private demand. And there were two sets of actions. One was, of course, this direct tax cut for households, and that will be boosting consumption. But at the same time, the number of measures that were announced to boost the private confidence in investment were also impressive. Of course, we'll have to see those in actions, because the most important one that I was highlighting in my report before the budget is that India needs to take up deregulation. It's also incidentally highlighted by the chief economic advisor in his economic survey. And I agree with his conclusions on that front, that now the big story that India needs to focus on is deregulation to get the private capex going. Any entrepreneur who is trying to make the investment, whether domestic or foreign, when they go to make the actual investment, it's at the state level where they're facing a lot of bureaucracy and a lot of hurdles. So this ease of doing business is also a good announcement that the budget made. We'll have to see what it shows up in terms of actual actions. But I was happy with that measure being taken as well.
To your point, consumption may be boosted, $12 billion worth put into the pockets of the middle class. I'm just wondering whether that is just a short-term solution for the economy. Do you see a longer-term strategy to drive growth higher?
Yeah, so the longer-term strategy, as we have put out in our report, is that India actually needs to target minimum double-digit growth rates if it wants to take care of the need to create jobs for the rising working-age population. And so in that context, ultimately, if you see how it evolved in China, China's consumption to GDP has been and is still lower than India. but China's consumption growth, when it was growing at double digit, was much higher than India. So the way you boost consumption is by job creation. And for job creation, you need to boost investment. And so I think the budget has also taken care of that objective of boosting investment and job creation through this measure that I announced on deregulation. But I would say that, you know, the ask is still a lot. You need to increase infrastructure investments aggressively. You also need to ensure that you take up adequate measures for skilling of the labor, in addition to this deregulation measure that the government has announced.
And of course, we know Modi wants manufacturing to account for 20%. I mean, from what you see in the budget, is he helping manufacturing at all?
I think the intentions are clear, and the effort is also being made in this budget. But, you know, India has kind of not been able to get that manufacturing sector's share in GDP, even in the last 5 years' effort that the government has been making. We've not seen the outcome of that in a big rise in manufacturing sector share in the GDP. So the effort needs to be doubled up, and we also need to ensure that some of the announcements or intentions are reflected in actual actions and delivered.
Chetan, thank you so much for joining us. Chetan Ahya, Chief Asia Economist of Morgan Stanley. Now, still ahead this hour, we speak to India's Chief Economic Advisor about the massive tax cut bonanza for the middle class handed down in Saturday's budget. Keep it here with us. This is Bloomberg. Is not a pretty Monday. Asian benchmarks pretty much in the red on the back of Trump's tariffs, of course, imposing tariffs on the likes of Canada, Mexico, as well as China. China getting slapped with 10% tariffs, of course, triggering a sell-off pretty much across classes. The move is seen as the most extensive act of protectionism taken by a U.S. president in almost a century. Taking a look where we are in terms of those benchmark MSCI Asia Pac Index down almost 3%. The TAIEX down almost 4%, and Nifty futures currently trading lower by 0.9%. Not a pretty picture when it comes to Asian currencies as well. We've seen the dollar surging pretty much 6 days in a row, putting a lot of pressure on Asian currencies. The yen currently trading down by 0.3 to 1%. The yuan currently lower by 0.5%. Of course, we've seen the PBOC supporting that currency, keeping the currency pretty stable. Korean won, not spared either, currently lower by more than 1%. And the Aussie dollar currently down by a massive 2%. Again, the dollar story has remained intact. The mighty dollar, the dollar index currently up by about 1.3%. Not to be spared as well, cryptocurrencies. Take a look at the movements that we're seeing so far. Bitcoin, not too bad, but Ether slumping 13%, at one time lower by almost 26%. So nothing spared. Still to come. India's chief economic advisor thinks the global political and economic environment will be a major factor in the country's growth outlook. We'll speak to him next about that and the Modi government's aims with its new budget. Keep it here with us. This is Bloomberg. All right, India has given the middle-class consumers $11.5 billion in tax relief in its latest budget in a bid to shore up the economy amid growing global risks. But there was little direct support for the millions of unemployed. For more, let's bring in our South Asia economy editor, Ruchi Bhatia. We'll get to Ruchi just slightly later. In the meantime, take a look where we are in terms of Indian bonds. Of course, expectations are in the market that we'll see that rate cut by the RBI to help support the economy. This is an economy That's pretty much grown at about 8%, and that's been lowered to about 6%. Expectations are that that rate cut will come this month. Taking a look at where the rupee is right now, 86.61 flat versus the USD. Let's get to our South Asia economy editor, Ruchi Bhatia. Ruchi, talk to us about this budget. I mean, was it in line with most people's expectations?
Well, the expectation was that Finance Minister Nirmala Sitharaman in her 8th budget would give some sort of a relief to the middle class, and that's exactly how it has played out. But one, of course, needs to see how the middle class now will react with more money in their hands. The expectation is that the marginal propensity for the people in various income groups will go out to spend. Remember, that had become a big concern for companies, with companies in fact, even in their business updates, saying that people were not coming out to spend. They were holding back on their purchases. And that is something that we had seen in the last few quarters, really, the kind of commentary that was coming in from various companies. But it is expected that this $12 billion worth of income tax cuts that Finance Minister Nirmala Sitharaman has announced will bring the much needed cheer for the middle class. And the budget really had something for everybody. In fact, as far as the capital expenditure is concerned, there also we did see a record number of 11.3 lakh crore rupees. So that is something that one has to watch out for. Although the pace of capital expenditure, as far as the government is concerned, has gone down. As far as the rating agencies are concerned, there was a roadmap for how the government plans to be able to decrease their debt to GDP as well, even as the government has not just stuck to the path of fiscal consolidation, but bettered their fiscal deficit target and narrowed it to 4.4% for next year as compared to the expectation of 4.5%.
Ruchi, we're keeping an eye on the Indian rupee. Not a great day either. Now at a record low, breaching at 87 to the dollar level. Just to follow up on the budget released on Saturday, you talked about how it's helping the middle class, but it's certainly not helping the unemployed. Nothing for them. And we're talking about 40% and 30% of them are grads with no jobs.
Well, Haslinda, remember, Finance Minister Sitharaman in her last budget speech had earmarked 2 trillion rupees for skilling people, for getting more jobs for people, and some of that money will trickle in this year. Yes, her budget speech did not mention the word jobs several times, or even unemployment, but some of the schemes, for example, a policy for labor-intensive sectors like tourism, like leather, footwear, a policy for MSME, toy manufacturing, are all aimed at making sure that India becomes a hub of manufacturing and also is able to provide employment for its vast young workforce.
Ruchi, thank you so much for that. Our South Asia economy editor, Ruchi Bhatia in New Delhi. Well, joining us now is Anantha Nageswaran, India's chief economic advisor. Van, good to have you with us. Shame we're not in the same space. Talk to us first about the tariffs. Talk to us about the tariffs imposed by the U.S. on a slew of countries. How is India looking at these tariffs?
No, look, Haslinda, this is something that just kicked in a couple of nights ago. I think it's a bit premature to speculate on its implications for India and how India would respond, etc., in public, because it is hypothetical. As far as India is concerned, currently the impact on it will be via the financial markets, which, as you showed in your own screens, the rupee is slightly weaker, but so many other Asian currencies have been weaker today, and the Indian bond market is quite stable. Yes, I think if I'm not mistaken, you did show that the Nifty futures are down about 0.9%, etc. But these are all anticipated reactions given the uncertainty that it has set in motion. But specifically with respect to India, I think it is not possible for me to speculate on the impact at this stage.
Even as you talk about how Asian currencies have been impacted equally, the rupee is currently at a new record low. We are seeing the trickle-down effect from the tariffs that have been imposed. I mean, how is India trying to insulate itself? And if you take a look at the budget, is there anything in there that actually helps India counter what we're seeing in the macro environment?
That's right. I think the correct, that's the right way to put it. I think we do, the economic survey released the day before the budget did speak about the global uncertainties being very high, geopolitics, geoeconomics, etc. And if you look at what the budget has done, it has done precisely to address that by focusing on domestic demand drivers. So what you and Ruchi spoke about a few minutes ago, about the tax cuts given to the middle class especially, are going to boost not only spending power, but indirectly it will also nudge the private sector to ramp up their capital formation, because this extra purchasing power in the hands of the middle class will boost their spending, leading to better capacity utilization and calling for higher capital formation as well. So in that sense, it is not just only directed at boosting consumption. It is also meant to boost private sector capital formation. So that is one way of sort of boosting the domestic demand drivers rather than relying on external drivers. And secondly, if you look at the various other provisions related to the small and medium enterprise sector, and a major 1 trillion rupee programs covering 100 districts on boosting agricultural productivity, the emphasis on ensuring domestic energy security without relying on external sources for critical inputs like minerals, battery cells, and lithium-ion batteries, etc. The budget basically does speak for medium-term Indian economic growth outlook through building domestic resilience. So in that sense, the budget displays a full cognition of the uncertain global environment that prevails at this point in the world. Back to you, Haslinda.
Van, you talked earlier about how it's too premature to talk about the impact, potential impact of those tariffs on India's economy. What scenarios, what scenarios are India preparing for in terms of the risks from such tariffs?
Look, I think, again, as I said, these are sensitive matters, and whatever the government of India is preparing based on consultations within various ministries led by the Ministry of Commerce is something that I will not be able to comment on in public at this stage. You have to bear with me, Haslinda. Back to you.
Can you comment on the rupee, which is at a record low? Are you comfortable with where the rupee is trading right now?
Yes, I am. And I think we need to put these observations, such as the currency being at record low against the US dollar, in perspective. I think it is always the case that countries that have a slightly higher inflation rate compared to the United States will always, by and large, see their currency depreciate against the US. And that is what has been happening. And therefore, these characterizations of the currency being at record low probably convey a different impression than what it really is. It is basically moving in line with the fact that the inflation differential at this point warrants a slight rupee weakness, which is what is happening. So I think in some sense, the rupee doing better than others because of strong domestic fundamentals, and at the same time moving in line with the inflation differential is par for the course. Back to you.
Van, talk to us about India's move to cut tariffs when the US is actually imposing tariffs. Give us a sense of the thinking behind it. Was the move to placate Trump?
I think India, the Honorable Finance Minister, in her two recent budgets, the one that was unveiled in July after the elections and the one that was unveiled the day before yesterday, both of them have embarked on the process of rationalizing India's import duties, making sure that the inverted duty structures are removed wherever they can. And she has also put many electronic components, critical minerals out of the customs duty framework at all completely by reducing the basic customs duty to nil. And also in the process, she has incentivized the domestic manufacture of end products in these items. And then she has also moved to remove several, customs duty rates, simplifying them, etc. So I think These moves would actually bring India's customs duty, the average weighted average tariff rate, closer and closer to the ASEAN levels of customs duty. So India is doing what India needs to do for its domestic context, which is to make sure that primary and intermediate inputs are available at cheaper rates, ensuring competitiveness of domestic manufacturing, and also plugging India into the global supply chain. So last two budgets, including the one that was presented 2 days ago, are taking the right steps with a view to making sure that we are able to make our manufacturing competitive and bringing down import tariffs, regardless of what other countries are doing with respect to their domestic circumstances. Back to you.
Well, some people say that what India really needs to do now is to cut the red tape. When do we see that happening? How necessary is that for you?
Thank you. It's been happening. In fact, we specifically reiterate that we have to move from phase 1 to phase 2. In phase 1, a lot of low-hanging fruits, both at the union and the state government levels, have been plucked. In the economic survey, we do point out that those states that undertook business reform action plans saw a big boost to their industrial activity as well. So the proof of the pudding was there in the eating, and this is now to nudge them towards the next level of deregulation, specifically with respect to land and building regulations, labor regulations. Most of them happen to be at the level of state governments. And that is the roadmap that Chapter 5 of the Economic Survey brings out, giving the state governments a pathway to begin to do these things such that other deregulation efforts can roll on from that point onwards. So it is not something that is going to start afresh. It's been in motion. We are exhorting the state governments and also some wings of the union government to take it to the next level as well. Back to you.
Well, the financial services sector is an important sector for India's economy. There's a lot of debate over the H-1B visa for the U.S. How do you weigh on that? I mean, how concerned are you it may impact the growth of the sector?
I think the domestic value-added services, particularly information technology-related services, have moved a long way away from dependence on Indians working overseas for foreign companies or Indian companies located overseas. With the establishment of global capability centers in the country, and here again the budget does provide for a good tax certainty and other policies related to the diffusion and spread of the global capability centers in second and third tier cities as well. I think several companies are now looking at India's smaller towns and cities, taking advantage of the skilled manpower that's available there. So in that sense, the discussions on H-1B visas are ongoing. In any case, I think the United States government, including the president, have spoken in favor of skilled and legal migration. So we don't see that impacting India's H-1B visa situation. But that apart, if the people are not able to go to locations where those jobs are undertaken, it is these days the jobs themselves are coming to where the workers are via the global capability centers. Thank you. Back to you.
Van, you talk about how the budget is addressing the pressure points in India's economy. Can it get back to 8%, or is 8% a blip? Is a realistic target for growth for the longer term 6.5% or slightly above that?
No, I think it's premature to say that we are consigned or destined to grow only at 6.5% for the longer term. That is not the case. When the global environment changes, as it will, because what prevailed over the last 25, 30 years, roughly starting from the 1980s, has changed now. And this too will change at some point. So these are cyclical in nature. Given the current context, and given the difficulties in boosting exports because of rising trade barriers, and given the difficulties in sourcing investments, foreign direct investment, due to various other restrictive measures also coming in the way of investment flow and trade flow, we are realistic in projecting a minimum achievable growth rate of 6.5%, which still is the fastest growing, this is the fastest rate among major economies. But when the global conditions change, we will be able to grow at a much higher rate. And what we are doing right now is to prepare the economy to be competitive enough to be able to achieve those growth rates when the external environment turns conducive. Back to you.
The thing is, Van, it takes 8% growth for Prime Minister Modi to get to his developed nation ambition by 2047. Is that ambition still intact, you think?
Absolutely, because if you do the math, 6.5% in real terms in rupees, and if you add the nominal growth rate of inflation of around 4%, we are talking about a nominal GDP growth of 10 to 11%. Historically, India between 1993 and 2023 achieved a dollar GDP growth rate of 8.6% every year. So now, depending on the trajectory of the US dollar Indian rupee exchange rate in the coming decade or so, this 11% in Indian rupee terms can easily translate into 10% growth in dollar terms, and that will see us achieve the dollar GDP growth levels that we are looking at by 2047. It is still very eminently achievable, Haslinda.
Van, always a pleasure to speak with you. Thank you so much for your time today. V. Anantha Nageswaran, Chief Economic Advisor at the Government of India. Let's do a quick check on the Indian markets. Been trading for about a minute now, under pressure like the rest of Asia, but marginally. Sensex index down about 9/10 of 1%. Nifty index also under pressure. Take a look where the Indian rupee is trading right now, 87.16. It is a new record low, down 0.6 of 1% versus the USD. Of course, it is the mighty dollar story. Well, joining us now is Keki Mistry, former CEO and Vice Chair of India's HDFC. Keki, good to have you with us. It's been a long time since we've been in the same space. I'm just wondering, do you agree what Van said earlier, that India's growth is actually intact?
I would say so, absolutely intact. I would say the growth will only accelerate over a period of time. You know, even if you look at it in the current context, last year we grew at 8.2%. This year's growth probably will be 6.6, 6.7%. But I think in the next 2 or 3 years, we will certainly get back to a much higher growth rate. If you look at the budget which came a couple of days ago, what was it that we were looking for in the budget? We were looking for growth. We were looking for domestic consumption. We were looking for job creation. And we were looking for some overall reforms. I think we saw all of that. We saw growth coming.
Where did you see job creation?
We saw job creation because of the fact that you left a lot of money in the hands of consumers. Now, when you leave money in the hands of consumers, people will spend more money. When spending increases, demand for goods and services increases. When demand for goods and services increases, automatically manufacturers need to produce more. If they need to produce more, they need to hire more people. They need to set up more facilities. So it's not going to happen immediately, but it will happen with a lag of 2, 3, 4 quarters.
What didn't we see in that budget? Some say nothing for farmers, nothing for industries.
I don't think so. I think indirectly everything, the rural economy, there was a lot of reforms in the agricultural front. So that obviously benefits the farmers. Industry also got benefits. If you look at the consumption trend, consumption will ultimately benefit industry.
Will animal spirits be revived, do you think?
No, absolutely. I don't think animal spirit has gone away even today.
We've seen an exit of foreign investors, for instance. Do you think that budget is enough to reverse?
Look, I think foreign investors exiting India is not a function of what India is doing, but a function of what is happening in the rest of the world. We are living in an extremely volatile global environment. And in that global environment, India, everyone will get affected. India will also get affected. But we will get affected a lot lesser than other countries, simply because of the reliance on our domestic economy. Our domestic economy is so strong that we can survive with some impact, obviously, because of the global uncertainty. But if you look at other countries, which are huge export-oriented, they obviously have some kind of a challenge.
Keki, let's talk about India's financial system. Some say perhaps the Goldilocks moment for India is over.
Oh, why do you say that?
So you don't think so?
I don't think
in terms of the financial system?
I don't think so. I think the financial system is extremely strong in India. I think the the regulatory framework in India is genuinely very strong. Whether you look at banking, you look at the NBFCs, you look at capital markets, you look at the insurance sector, we have extremely strong regulators. If you look at the banking system today has the lowest level of NPAs it's had in probably history. So very well regulated, very strong financial sector, good asset quality, and most importantly, very underpenetrated market. So if you look at any financial service product, anything, you look at housing loans, look at car loans, consumer loans, auto loans, you name it, credit cards, stock markets, whatever, the penetration levels in India are extremely low. And India has a young population. So as you know, 2/3 of our population is below 35 years of age. And a lot of the people today are not consuming to the extent that they will in the years to come. So as people keep getting jobs, as people keep earning income, they will spend money, that consumption will keep the economy rotating on its own. So I'm very bullish about the Indian economy. I think the only thing we have to manage is what I think you mentioned, that we have to ensure that there are enough jobs being created for the people who are passing out from business schools every year. Now, if you look at job creation, you look at the financial sector, you look at the frontline people in the financial sector, the people who are going out and selling goods, the attrition rate is very high. Now, why is the attrition rate high? The attrition rate is high because people are getting better jobs, more opportunities, and, so it's not that jobs are not getting created.
There's a lot of talk about financial inclusion. How do you accelerate the process in a country like India where so many people are still unbanked?
No, I think you look at India in the last 10 years, and you see the quantum of financial inclusion, the amount of financial inclusion that has happened in the system. I mean, there are multiple examples starting from these Jan Dhan accounts and so many things. I think digitization has been a huge success in India. So in the last 10 years, India's growth, everything that India has done actually has gone towards creating more and more money in the hands of poorer and poorer people. Without just doling out money.
Given the optimism that you're expressing for the financial system, I'm just wondering, what's the outlook for credit growth in India?
Look, credit growth...
If you can put a number to it, it's even better.
I would put a number to it. I would say I would not look at quarter on quarter, because I think that's a very wrong way to look at it. But if I was to look at a 5-year view, I would say certainly we would look at a mid-teens kind of a growth, 15-ish percent type of growth. If you are looking at a GDP of around, let's say 7.5% to put a number in a medium term, and you're looking at inflation of, let's say, 4%, you're looking at a nominal GDP of 11.5%. Roughly 11.5, 12%. And you should be looking at the loan book growth, which is typically 15% higher than that. So somewhere in the 15% is probably where I would put it.
Keki, I want to get your thoughts on the merger between HDFC Bank and HDFC Limited. How is it going?
Going very well. It was done in June of 2023. It's fully set in. I mean, we had a whole 1 year and 3 months, 15 months to prepare for the merger. So therefore, all the systems were aligned, people's roles were aligned, and the merger between a bank and a housing finance company like us, even though we were a financial conglomerate, as a company we were a housing finance company. So the merger was not that much of a challenge from a people's point of view, because the bank did everything other than housing, and we did only housing. And therefore, all the housing people who were specialists in doing housing automatically merged into the bank because it didn't have a role over there. Some degree of duplication would have been there in corporate roles, but that was sorted out pretty well.
Keki, thank you so much for your time today. Great insights there. Keki Mistry, former HDFC CEO and Vice Chairman. Well, one potential growth area for India is streaming. I spoke to Nita Ambani, the founder and chair of Reliance Foundation, who is now heading up the recently inked joint venture with Disney.
Once sport takes over, the transformation will be seen, not only in the lives of the youths, but in the economy of our country. India is one of the biggest centers for digital usage. I mean, Tokyo Olympics was watched the most, had the highest amount of digital engagement in India. And 1/3 of the viewership of the Olympic channel comes from India. So India as a sporting market is huge.
And that was Reliance Foundation founder and chair Nita Ambani speaking to me about India's role as a key market for the global sports industry. And that's just a taste of our wide-ranging conversation. You can catch it in a full on the latest episode of Latitude, premiering on February 13th on Bloomberg Television and, of course, on our YouTube channel. Subscribers can also watch on the terminal. In the markets, let's take a look at how U.S. futures are pointing to, bearing in mind that Asia is pretty much in the red. No different for U.S. futures. S&P futures currently down by about 2%. NASDAQ futures down as much and ain't looking pretty for the Russell 2000s as well. Now, before we go, here's a look at tomorrow's program. An exclusive here in Mumbai with Sanjeev Bajaj, chairman of Bajaj FinServ. We'll discuss the conglomerate's business outlook as the world grapples with growing volatility from Trump's policies. Plus, we'll dive deeper into Indian markets with Brian Kurzmak from GQG Partners. That is it for Insight. Horizons Middle East and Africa is next. This is Bloomberg.